Well, folks, looks like things just got a little bit worse for the market. We've been really tracking this ever since Snap came out shortly after posting their earnings and their guidance saying, hey guys, actually, we're not going to meet this guidance. Well, we were then followed by Microsoft lowering their guidance. We were followed by Tesla cutting its 10% of its workforce, saying that the economy looks bad and they need to cut costs. Or as Elon Musk put it, super bad. We had Nvidia lowering its guidance. And now Target saying that it is actually not going to be able to meet the guidance that it provided last earnings because it actually has a surplus of inventory that it is not able to offload. So we might be seeing a little bit of that demand destruction now take place because of the fact that price instability and inflation are still at record highs, and people are now paying more for things such as gas and food that they're not able to buy other things that they once were. In addition to that, we also have the Fed trying its best not to put us in a recession and initiate what we call a soft landing. But essentially, everything the Fed is doing, because they cannot control the supply side of the supply-demand equation, they are trying to control the demand equation without killing demand and causing a recession. We're also going to be talking about Recession Watch. Obviously, there's a poll that just came out that shows that 75% of Fortune 500 CEOs believe a recession is inevitably on the horizon. Last month, we saw around 16,000 tech jobs being lost due to rounds of layoffs. And I'm tracking this unemployment rate very closely. I'll tell you why in a bit. The Fed GDP tracker shows that the economy could be on the brink of a recession. Currently, the Fed GDP tracker is projecting a annualized growth of GDP of 0.9%, which is dangerously low because that is essentially a margin of error where we could come shortly below that and we would officially be in a recession. Since last quarter was negative, if we get 2 negative quarters of GDP numbers, that would officially put us in a recession. So if they're just projecting 0.9% for the next GDP reading for the next quarter, then that means that there's a chance we could come slightly under that, but slightly under that could also mean that we get a consecutive negative quarter of GDP. In addition, we got the U.S. consumer credit report today showing that U.S. consumer credit continues to skyrocket. And part of the reason for this is most likely because Americans are paying more for things such as gas and food, so they are needing to use more credit. We will get into all of this as well as a market update, and I will tell you what stocks I'm looking at and what this potentially could mean for our portfolios, because it is not all doom and gloom. I do think that we are much closer to a bottom than we are to a top. I'll get into what that means. I promise I'll explain it in detail. If this is the first time on the channel, welcome to The Traveling Trader. Let's get right into it. So Target came out and they shocked the market today. And the reason is because they just reported their earnings report just a few weeks ago, right? So basically what analysts are saying is that how could Target miss the mark so much? Like, what could have changed in the last couple of weeks between when they reported earnings, gave guidance, and then 2 weeks later said, we actually have to cut that guidance because we have a surplus of inventory? That all could not have happened within 2 weeks. So why did they give guidance, or why did they give false guidance initially during their earnings report? Now, as of the time of this recording, on the day this happened, shares of Target were down like 8%, and they recovered nicely to be only down 2%. Now, I do think that there are some budget retailers here that are worth buying, that are beaten up 50% or more, and they pay a nice dividend. They still are profitable value stocks that I don't mind buying. So we will get into that when I talk about some of the stocks that I'm looking at, which will be towards the end of the video. However, like I said, this is a disturbing trend because we had companies like Nvidia lower their guidance. Companies like Microsoft come out way ahead of their next earnings round in the summer, saying that they're lowering fourth quarter guidance. Remember, the only thing at the end of the day that the stock market cares about is earnings. Can companies deliver on their earnings? Can they continue to grow? And in a period where consumer prices are wild, producer prices are wild, it's going to be much harder for these companies to actually deliver on their earnings and have good margins. It's also going to be much harder to evaluate these companies at multiples that they were evaluated at when interest rates were low, because now the present value of future cash flows is going to be lower due to the fact that interest rates are higher. So this all leads us to the CPI data that is coming out on June 10th, which is going to be a Friday. Now, the CPI data on June 10th, the median forecast for that CPI data is 8.2%. However, based on a derivative called a fixing, and I'm not going to get into exactly what that is, but it is a type of derivative, a type of swap that is basically betting on what the CPI data is going to be. That market is reflecting that investors are expecting an 8.5% year over year inflation. If it comes in at 8.5%, that's going to be more than it was last month, which you definitely don't want to see. You want to see inflation slowly descending, or hopefully quickly descending, but that's not realistic and that's not going to happen. You want to see inflation descending, not ascending. So if we do get a year over year inflation rate that shows that we are actually climbing and not retracting, the market could be in for more pain. Now, if we take a look at the VIX, the volatility index, which is basically the fear gauge index based on how S&P 500 options are trading, we've had 6 straight declining weeks of the volatility index, and we are now at 24, the lowest level that we were at since April. I can see for the next few days, volatility continue to drop until that CPI number is released. And if that CPI number comes in higher than expected, then we can expect the VIX to shoot back up, and this would in turn bring the market back down. However, like I said, I do think that we are closer to a bottom than a top. Meaning, if you look at, say, the NASDAQ, for instance, it was down 30%. I don't think the NASDAQ has another 30% left in it to drop, meaning that if the QQQ was at around 280 at its recent bottom, I don't think the QQQ is actually going to drop to pre-COVID levels at around 162. Say the inflation number is higher and we do get a drop to, say, the 200-day moving average. Well, that's another 5% from its trough. Now, why am I saying this? I'm saying this because I do think that there are decent opportunities here for beaten down stocks for people to start adding for the long term. I'm cautious about going all in here because of the factors that I talked about. Also, because of the price of oil, which tends to precede a recession, right? When oil starts hitting highs, that tends to precede a recession. So we already had the inverted yield curve. The price of oil is pushing 120 a barrel again. We've had layoffs in the tech sector. And like I said, I'm watching this unemployment data because if unemployment data starts ticking up, well, that has preceded every recession as well. And these gray marks here, these are recessions, these gray vertical lines here. And every time before a recession, you see unemployment crash to a low, as we are now, before ticking back up. And once we start ticking back up even just slightly, that is when we enter the recession. And then obviously during a recession, unemployment gets crazy. So I am watching this like a hawk to see if we start going from that 3.6% back up to 4% or above, then we can start thinking that a recession is actually closer than we think, in my view. So the stocks that I'm looking at, QQQ is definitely on there. This is the NASDAQ ETF that I'm looking to add for the long term. For those of you that are in the private trading group, you know that we bought Amazon near its post-split price of around 102, which was an absolute steal, almost 50% off from highs. And if you want access to all of our trades, long-term, short-term, etc., link is in the description below. We could not survive without this. This is literally the recipe for waking up neutral and playing each side of the market depending on which way it breaks. This is the options day trade watch list. Obviously, we have day trades going on all day as well. We have long-term picks, stock market analysis, etc. Come be a part of a community. Do not go at this alone. It is much better to be part of a community of thousands of traders talking strategy all day, every day. So Amazon was definitely on that list. Another one is a budget retailer that took a hit recently, and that is Walmart, 25% down from highs. Happy to pick up Walmart at 25% off, a healthy dividend stock that is considered one of the stalwarts of value stocks. We picked up Berkshire Hathaway at the 300-day moving average. This is BRK.B. These are the B shares, obviously the much less expensive Berkshire Hathaway shares. The Berkshire Hathaway A shares, I think, are $300,000 a share. And then going into a recession, I've talked about this before, but I really like the S&P Healthcare Index. This is XLV, which is the healthcare ETF of the S&P 500. I am also looking to make a play on XLF, which is the financial sector of the S&P 500, but it is currently in this descending channel, and I want to see if it's going to get rejected here and fall back down to the low 30s before jumping back in. As I said, I do think that there are some lucrative opportunities here. I don't think the market is totally hands-off. However, Given all of these scenarios that we discussed, also the fact that the FOMC meeting is coming out June 15th, although the Fed's hand is pretty much well known here, I think they're going to raise by 50 basis points and not really accelerate any sort of policy with regards to the balance sheet runoff. And then on June 29th, we have the third look at the GDP numbers from the first quarter. And then end of July, we have the second quarter GDP numbers, which is going to be the next major milestone for the market as well as the economy, because that will determine whether we are officially in a recession or not. So yeah, in my view, there are some decent opportunities here on stocks that a lot of people have been waiting for the dip on. But it doesn't mean that you just have to go reckless and blow your whole budget on the stock market at these levels. I think that one can afford to wait to see what June will yield. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think of a recession and what stocks you are buying. Come be a part of the community. Don't go at this alone. Learn how to trade in a down market. Learn how to bank in a down market. There's no reason why anyone shouldn't be. You shouldn't just be sitting on your hands watching your portfolio bleed, not knowing what to do when the market is tanking, because yes, you can still make money when the market drops. You can hedge when the market drops. It's very important to know these things. So come be a part of the community, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.